Alrighty, welcome. Welcome to our Defined Outcome panel. My name is Eric Chen. I lead ETP market intelligence efforts at Cboe Global Markets. We're thrilled to be on stage here today with four of this industry's most relevant defined outcome players. From left to right, Trent Houston, VP, Head of ETF Strategy at PGIM, Charlie Champagne, Head of ETF Strategy at Allianz, John Shellen, Chief Operating Officer at Crane Shares, and Oliver Bunn, Head of Quantitative Investment Strategies, Alternatives at GSAM. Defined outcome is a hot topic, right? We're in our sixth Defined Outcome panel here at the ETP Forum. And so before we start, just want to rattle off a few stats. As of May 30th, and I'll say this twice, as of May 30th, this category had $66.5 billion, right? $66.5 billion, about 24 up from this time last year. A huge testament to the players on stage, right? A huge testament to the folks that have been able to raise these assets in all sorts of market climates. I would start by saying that today, the category is hotter than ever, right? I want you guys to think about a couple questions as we go through today's panel, right? First and foremost, one that I'll carry over from a previous deck presentation, and that'll be who's buffering what, right? Given that this is the investor track, we'll walk people through not only the product side of a lot of these tickers, right? A lot of these funds, but also walk you guys through some of the distribution aspects, right? Distribution developments and new ways people have kind of taken up these funds. I'd love to start with the topic of reference assets, right? Today, we've got 400 odd tickers in the space, of which we see a lot of redundancy in different reference assets, as well as folks that have definitely acclimated to new and novel reference assets. A lot has happened since the last ETP forum, and in April, we saw obviously Liberation Day happen, right? And we saw people price out the impacts of tariffs, both domestically and internationally. I think one thing that's absolutely fascinating is the popularity of a lot of international underliers, right? And with that, I'd love to start with John. John, as Chief Operating Officer of Crane Shares, right? You guys uniquely own the entire ecosystem, right? From front to back, you own the reference asset, right? You own the buffers. John, I'd love to hear from your point of view, what is really the importance of having an international reference asset in today's climate?
Eric, thank you. And thanks everyone for joining us for this panel. I'm Jonathan Shellen. So I'm the COO at Crane Shares. And for those of you that don't know, Crane Shares is a specialist asset manager focusing on China. We're very well known for our flagship KWEB ETF, which focuses on China Internet. In the climate space with carbon and then alternatives, where we partner with leading managers to deliver liquid alts. But because of our history and focus on emerging market and China investing, when we entered into options-based strategies a couple of years ago, we realized that our way of doing it was really quite unique. Just to give you an example, even though the defined outcome space and even the covered call space has grown massively, and even though we launched a covered call strategy 2 years ago when we began managing options-based strategies, there are really only 3 international covered call strategies today in the US universe. That's pretty wild. And I can tell you this, it's becoming much more important to consider what is the underlying in your defined outcome strategy, particularly now that Trump's made diversification great again. Quite frankly, it didn't matter over the last 10 or so years, where all you had to do is invest in the S&P, get an S&P with buffers or some kind of collar around it. But now, as we see what's happening in currency markets and the resurgence of non-US investing and emerging market investing, having a buffer on a reference asset outside of the US is relevant. And my job here today will be to help you understand that the same types of diversification benefits that appear in a portfolio by blending US and non-US can also apply within the buffered space and the defined outcome space.
That's fabulous. Charlie, anything to add? I know you guys are on file. We're having some MSCI reference underlier.
Yeah, no, I think it's an important topic. And, as we know, the buffered ETF space is kind of dominated by large cap US equity and the S&P 500 with about 85-90% of assets there. But, I think international developed markets are perfect for the buffered space for a number of reasons. On a returns basis, directionally, it kind of falls in line with S&P 500, but the magnitude of those returns vary quite a bit. So having a hedge on that type of exposure can be important. One thing that we've heard over and over again from clients is, they use that diversification, that international equity exposure as a kind of an alpha seeking position. It's not their core position. So they're hesitant to cap a product like that. So, one thing that we do is we've created this uncapped version of buffered ETFs, right? So we structure it so that there's a spread component or a hurdle rate. And we do this with the S&P 500 that way that once a reference asset gets beyond that spread, all upside is captured beyond that. And we found that EFA or MSCI International Developed is a great reference asset for this strategy because the high dividend yield provides a nice narrow spread. I think it's around 2% right now based on where the options are pricing. So for investors that are worried about missing out on some of that alpha that they're looking for, that outsized return that they can get in the space, this might be a better option for that. We plan that's going to be coming to market in the next couple of months here. So it's really about figuring out the best way to, capture the essence of the asset class or the reference asset without, with providing some protection on that and not hindering the upside as much as possible.
And Charlie, it's really interesting that they touch on the uncapped strategy, right? We just heard in the panel upstairs that really this entire category has been a subculture of shuffling capital, right, between different floors and caps, right? Would you be able to take a moment maybe just to walk us through how Allianz achieves that uncapped effect?
Yeah, so on a typical buffer with cap, it's a four-leg option structure. So you have a deep in the money call, or you can even hold an ETF just to get that long exposure. Then you have a put spread on top of that, and then you sell the call to which gives you that cap, right? So that you can spend your entire budget. So on the uncapped space, what we do is we have that deep in the money call to get our long exposure, and then we just have a put spread, but we adjust the pricing of the put spread so that we get to our 100% budget or allowance for budget. And what that does, it really just shifts that put spread up. So that sold put, it shifts it up, which creates that spread. So, when you buy the deep in the money and then you sell the put, you get to 102, for example. And then when you sell that put, you sell it at 102 so that you get back down to even. So it's a 3-option structure. It's a little bit unique. It's a little bit different. And it's new to the market. We've just finished our first monthly series in this past April. It's really getting a lot of traction at this point now.
Fabulous. And as we think a lot about what those international risks mean, right? What risks might mean just the buffer category in general. We take a look at last year, right? And I come back to who is buffering what, right? You had 3 major reference assets, all US equity indices last year, for which I think it's safe to say the buffer strategies grossly underperformed what were fairly runaway markets in those reference assets, right? And then you look at the 3 in 2024 that lost money, right? And those were your EFA, your EM, and your TLT underliers, right? And I think it's just exciting, right? Today, in a world where people not only see the importance of having that international exposure as a reference asset, but it's a timely topic, right? For a lot of folks, especially here at SIBO, as we anticipate quite a bit more volatility across different term structures. Now, it goes without saying that really 90+% of the assets in this category today are tied to an S&P 500 reference asset, right? And on stage at either end of the panel, we've got 2 different players that use different reference assets to achieve that S&P 500 exposure. Trent, why don't you kick us off just in terms of how PGIM arrived at the conclusion to use a SPY ETF underlier as opposed to, really all the other S&P 500 option eligible ETFs today.
Yeah, thanks, Eric. So at PGIM, we are an active manager. We don't have our own index products, and sometimes you see asset managers with their own index ETFs, typically using their products to help derive that long exposure, as Charlie laid out, kind of how the options package works. For us, as an active manager, we are just going to use what we thought was the most liquid option out there, which was SPY options, to simulate that long S&P 500 exposure. It's probably the most common approach in the buffer space when you're looking specifically at the S&P 500 reference asset group, is to use SPY as the kind of underlying options package that you're going to rely on to get your exposure. I think everyone here will talk about why we're talking ETF options and not index options in this space. And that has to do with the in-kind ecosystem, the tax efficiency of these products. Using ETFs or ETF options is critical in making sure that you are having favorable tax outcomes for people who are investing in these products. But it wasn't really a particularly challenging decision, given that we didn't have our own in-house option on the ETF space. SPY is the most liquid option in the ETF market, and using that made all the world of sense for us.
And Oliver, at GSAM, you guys have certainly taken a road less traveled, but in some ways it's almost a pure approach, right? Maybe talk us through some considerations in having SPLG as your reference asset.
Yeah, no, definitely. I mean, we heard the story of why SPY is a kind of potentially relevant and interesting option. It's very, very liquid. What we found is that the differential liquidity between essentially SPY's smaller brother, which is SPLG, right? It's the same provider. It's basically like the second generation ETF, comes with a lower expense ratio. So we thought basically as part of our decision process, okay, let's kind of try this. Part of the very important considerations that we already heard about why you want ETFs and options on ETFs in your portfolio, they similarly apply. Once you talk about the defined outcome structure, however, you typically kind of try to basically provide some very, very precise exposures. So once you talk options, you're most likely talking flex options. So these are basically options that have customizable terms. And of course, at times when they get traded, then they ultimately list. But the advantage here also for the counterparty is when you go out and you basically ask them for quotes on SPLG in terms of the hedging, and given the proximity that many of these ETFs have to each other, it's pretty much the same hedging effort. So that basically was for us enough to say, all right, from a liquidity perspective, we're actually comfortable with essentially using SPY's smaller brother, but then kind of utilizing the benefits of the lower management fee at that point.
No, it's fabulous. Charlie, anything to add? I know you guys also use the SPY underlier in addition to some others.
Yeah, so we also use like Trent and PGIM, we use SPY Flex for all of our structures currently. But what I really like about this industry is the evolution, and we see that with what they're doing at GSAM and some other issuers have as well. Is they're not using a full option structure. They're using an ETF as the deep in the money as the long exposure. They're using it on SPLG, which is a low cost option. So just even the evolution of what for issuers are using for reference assets or what they're using for their structures is growing. It gives a lot more option for the investor, and so I think it's a great thing that we keep saying.
Fantastic. And as we introduced this panel, right, I come back to a space today that has more than 400 distinct tickers, right? And these tickers are representing different tranches of different strategies with different strategy expirations, right? At the top and bottom of various months. One thing that's remained evergreen from a consumption perspective, right? Cognizant that we are on the investors track here in this room, is the concept of a ladder strategy, right? A fund-to-fund strategy for which certain issuers, almost all issuers, right, have kind of taken up that concept to offer investors a single ticker solution, right? As opposed to encouraging, that monthly or oftentimes even more so rebalance between all your various tranches. Trent, why don't you kick us off there, right? In terms of what value PGIM sees on that fund of funds approach, right? And really, your thinking when you all brought that to market.
Yeah, happy to do so. And I may be a little long-winded here because this is one of my favorite topics in this space, because I do think the idea of a laddered or evergreen defined outcome approach, and I maybe use these terms interchangeably, but actually is probably going to be one of the more powerful drivers that can ultimately continue to facilitate the growth of this space. So when we talk about a laddered strategy, as Eric mentioned, for us at PGIM, and it's a pretty common structure in the industry, it's a fund-to-fund structure. So it's a ETF that buys all of the monthly buffer ETFs in a given series. So you have 1/12 exposure to every single buffer ETF in that series. Usually do it in equal weights. There's some products that do it with a little more active management, but for us, we do it in equal weights. And effectively what you're doing there is just buying a blended exposure to the defined outcome product, defined outcome series. And in doing so, you aren't going to then have a defined outcome period. You're not going to have a cap. You're not going to have a buffer. But what you're going to have is persistent exposure to the buffer ETF performance profile. I liken it to buying a bond mutual fund, right? A bond mutual fund doesn't return par. It doesn't have a coupon. But overall, the bond fund itself has characteristics that look just like owning an individual bond in that fund. The same way when you buy a laddered or blended approach to buffer ETFs, you're not going to have a defined outcome. You're not going to return you're not going to have your buffer and your cap after the end of 12 months. But over the long term, you're going to have a performance profile that looks like owning an individual buffer ETF and continue to roll into new outcome periods. And what that does is it reduces timing risk. It reduces some of the administrative burden the same way folks may prefer owning a bond fund versus individual bonds. But more so, it then kind of takes a more of a step back and a broader, longer term view of what the performance profile of defined outcome and buffer ETFs really is. And what it is a lower volatility equity solution. And we've looked at the performance profile dating back multiple decades for a moderate buffer ETF, going back to 1997, and we found that it's exceedingly similar to the after-tax returns of a 60-40 portfolio on almost every rolling basis or rolling time frame. And when you take a step back and think about what that means, you have this kind of hedged equity approach that looks a lot like what a core of a lot of investor portfolios are, but this hedge is structural. It's not reliant on correlations persisting like a 60-40 portfolio is. It's not subject to factor risk that can kind of blow up in your face like they did in 2022 when stocks and bonds both sold off and investors faced really negative outcomes because the way they traditionally hedged themselves didn't quite work. And we think it's no coincidence that the rise of buffer ETFs in the last couple of years has come on the heels of that really negative 2022 experience for investors. And we think the opportunity to kind of take these evergreen or laddered approaches has the potential and a lot of runway to be a core replacement for portfolios. As Eric mentioned, we're 60 some odd billion in assets under management in this space today. When you think about what the runway is to replace your kind of core holding investor portfolios, that 66 billion feels like a drop in the bucket. So that's why we're really excited about what laddered strategies that kind of give you that persistent exposure or other evergreen approaches to this space can do in the long run, is that they can really reframe the way we think about portfolio construction in a way that you can kind of deliver that 60-40 experience in a much more reliable and dependable way.
No, it's fabulous. Charlie, you guys have also issued a couple of fund of funds. What was the thinking there?
Yeah, I mean, I think Trent nailed it. I think the biggest benefit for fund of funds is ease of use to the investor. It is a simple single ticker solution to get exposure to the space. We see our larger clients, RIAs and model providers, they run buffered models. They have their tactical allocations. So they're constantly monitoring Greeks, they're monitoring characteristics of the underlying ETFs, the monthly ETFs, and they're buying and selling based on what's advantageous at that time, right? The fund of funds is a buy and hold strategy, right? You get that exposure, you don't have to trade it. It's a core position. You don't have to worry about resets. You don't have to worry about caps and buffers, where volatility is, where interest rates are. They're going to change, and that's going to affect the caps or whatever the upside component is. With the fund of funds, it's basically an equal weighted approach to all of that. So it really kind of smooths out that experience, and you don't have to consider trading when a fund's about to reset. You don't have to consider the characteristics on a regular cadence. It's just a simple solution for investors to use and get exposure to the space.
Very interesting. And then I would point to another hot trend in the outcome-based category as being the 100% buffers, right? You know, we've got some research here at SIBO that points to the majority of buffer assets being raised in 2024 as really being a function of those 100% buffers. And you know, a lot of people have heard me say this, but in a world where there is no managed expectation, right, of 100% drawdown on really most of the reference assets in this space, it really becomes more of a product development exercise, right? You know, this entire category, right, is how you move upside convexity down to the bottom, right, and vice versa to achieve different outcome-based solutions. John, I'd love to start with you, right? Today with 2 buffer products in market, you started with the 100% and 90% buffers, right? And you know, obviously applied it to KWeb, one of CraneShare's flagship products. Maybe talk us through some of that thinking, right?
Sure, absolutely. And, you know, I should mention that I feel like right now we are in the 3rd generation of defined outcome strategies. And I'd say Gen 1 was actually defined income. It was just basic covered call writing strategies. Gen 2 is, you know, really kind of buffered strategies where you sell an out of the money call and buy some kind of put. And Gen 3 is managed equity. So putting some dynamics around that, maybe a put spread, moving things around. And I think there is a Gen 4 that's coming that we could talk about later on. Our evolution here started with a covered call writing strategy about 2.5 years ago called Clip, to generate, you know, option income of 4 to 5% a month, because we're writing calls there on KWeb, which has volatility of about 40%. So about twice the volatility of NASDAQ. And people really took to that. They said, oh, this is really interesting. It's generating significant income. But the challenge with a covered call writing strategy is you get downside. You have to have the drawdown risk. And we started having investors say, I believe that China is, you know, very cheap, valuations are low, fundamentals are good, sentiment is horrible, but I'm still not ready to take the plunge. And so because of our success with the covered call writing strategies and this recognition that KWeb is one of the 15 most optionable ETFs in the entire ETF universe out of, you know, 4,000 ETFs, let's say, it led us to pursue pure buffered strategies. So we launched a 100% buffer and a 90% buffer. And, you know, I kind of jokingly said, as soon as CraneShares launches a KWeb type ETF with downside protection, the floor is in. Like, you know, China has reached its bottom. And lo and behold, February of 2024, since that time, KWeb's up about 50%. So the prediction was relatively accurate. And so ironically, us giving the marketplace insurance made our investors more comfortable buying KWeb because they knew the insurance was there. So they didn't necessarily buy the defined outcome ETF, but they felt more comfortable knowing that there was protection available if they ever needed it. And what's interesting is because, I should mention, we launched these as 2-year horizon ETFs. Think about this time, a year and a half ago is when we launched the buffered ETFs. Interest rates were high, you know, kind of like they are today. Volatility was elevated because of a lot of the geopolitics, and skew was high. So we were able to achieve caps in our buffered strategies that were 2x the caps that you would normally see for similar US-based strategies. This is the other advantage of going overseas is you have higher volatility, and if you have appropriate skew, you can really get great outcomes. And so what happened is halfway through our 2-year period, we had a decision to make. What do? We're kind of moving in the direction. We still got a year to go, but we've moved away from our floors. Because remember, these are static strategies. If they start to appreciate meaningfully, you no longer have the protection that you offered day one. So we actually did something that at the time felt controversial and now seems like a no-brainer. We reset our floors and we extended. So we basically, turned over the portfolio, bought new puts, sold new calls, created a new cap, and reset our 2-year period. So now we've actually decided to re-up that protection and achieve caps that were very similar to what we had when we first launched the strategies, because the market hasn't changed much. And we felt it was important to lock in rates where they are now, because it's really difficult to know where rates are going to be. And quite frankly, a lot of these strategies are rate dependent, especially if you go out beyond a year's time and even with a year's time. So that's been a little bit of our evolution. I think investors are very interested in observing kind of how we do things, just given the nature of our assets and the China exposure and the emerging market exposure. But we feel very good about it and continue to be a leader in the space. I'll make one last mention. We did enter into the hedged equity space as well with an ETF called K-SPY, where we partnered with Hedgeye, and there we're using kind of dynamic signals, if you will, risk signals that mitigate risk and try to capture as much of the S&P upside while controlling downside. So as the marketplace has matured and evolved and moved from Gen 1 to Gen 2 to Gen 3, we at CraneShares have tried to evolve with it and are actually exploring what we think is the next generation of strategies in the space.
Very cool. Very, very cool. I'm going to take a moment to pivot now to distribution and adoption related topics. And Oliver, I want to start with you. I think, we learned quite a few very interesting things, right, during panel prep. And I think that starts really with some of the more tactical usage and institutional level mandates that buffer ETFs are starting to see, right? We see a little bit around, Liberation Day, right? And throughout all of, I would say, this asset class, this time in market, there hasn't always really been great leading indicators to flows, right? But all of a sudden, we're starting to see more tactical usage. Maybe talk us through some of those use cases that you guys are seeing at GSAM.
Yeah, but actually cast a fairly wide net when it comes to use cases. So I think the tactical use case is certainly one, but as the defined outcome industry has matured, I mean, you already mentioned the $60 billion handle. Essentially, we have evolved from a trade to an allocation. So that factors in kind of many factors that we've already heard, right? We heard about essentially you want to balance your basically risk aversion. We have a solution basically where we have very deliberately put in basically a floor at kind of some farther out of the money level, which is actually kind of came in quite handy during Liberation Day when those options actually started to appreciate quite significantly. Mm-hmm. The general kind of dynamism of that industry, we're trying to basically reflect through usage of like shorter periods, right? We heard about basically buffers in like the 1 year space, the 2 year space. We've kind of fairly deliberately tried to set ourselves apart to actually go into basically a more quarterly structure. So we basically have 3-month outcome periods. It's a use case that I would regard as like fairly complementary to what you're already kind of used to in the market. That somewhat like speaks to the fact of like, you want to follow the macroeconomic environment, where rates are going, where the skew is going, et cetera, and then basically have like structures that automatically adjust to that. Now, on the allocation question, a fairly kind of interesting observation that kind of we have made probably over the past couple of months is that when originally defined outcome ETFs came to the market, they were almost regarded as like, oh, you're trying to compete with structured notes and kind of players from like maybe the broker dealer side that are already in the market. And what we have found is actually that there can be an ecosystem where these two actually very nicely complement each other. Here, what we found, look, we have 60 billion in defined outcome ETF space, and of course, have kind of very kind of significant presence here on the stage here. If you go into the structured note space, we're talking a couple X times that volume, right? We're probably talking 5X, like 300 billion plus what you see in the structured note space. And now when you try to really kind of pursue a holistic sale, so you're kind of talking to an RIA and saying, look, you probably have kind of certain clients that have certain very custom demands that might be kind of very like high value clients of yours with a lot of assets to manage. You may want to consider a structured note, but the structured, basically the defined outcome ETF system can really be like the nice kind of undercarriage of that whole system. So you're using this essentially to kind of lean into certain themes kind of when you need it. You use it to basically service a much broader range of clients. And even for the client basically that you have like structured notes in place, this can be basically a perpetual vehicle that gives you the exact trade-off basically between equity exposure and risk aversion of where the defined outcome ETFs are playing, but gives it to you basically in this like evergreen and, I mean, let's admit it, lighter paperwork framework compared to what you would have to do when you do a structured note.
And I did want to touch on the tactical opportunity because I entirely agree. So if you look at 2024, and Eric kind of teed up 2024, what performed well, what performed poorly. But generally speaking, in a stable up market, you're not going to find tremendous tactical opportunities in buffer ETFs. Your best version is going to be buying the beginning of an outcome period, holding the entirety of the outcome period to get your defined outcome. You know, that's the way these are going to work. But then volatility does spike, and it does spike in periods like this spring around Liberation Day. And all of a sudden, there are short-term opportunities to stay in the market, to maybe get invested in the market with shorter outcome periods. You could find something that maybe has 3 months left on its outcome period, has given you now more capital to start with because the market's down, but you still have 10% buffer there. So you're saying, you know, I do think these are an opportunity to leg back into the market, but I'm not 100% certain, but I can still get back in, give myself 20% upside over the next 3 months, but still have 10% protection. Then there's a great way to tactically allocate amid volatility. And these opportunities aren't going to present itself every single year, but volatility is, you know, it's the name of the game in some regards, and it's going to happen. And I think buffer ETFs proved to be a really interesting solution for enterprising investors this spring. And I think we'll continue to see that being an opportunity for people to leg back into the market, to stay invested, to maybe, you know, up their allocations during volatility. And I think they're a great opportunity for people who are tactical to kind of play that toward a rebound game in a safer way, ultimately.
Yeah, so to add on to that, I agree with that 100%. We've seen that recently. You know, historically, when you look at flows and trading volume of buffer ETFs, the last day of the month, first day of the month is when you see the vast majority of all of the volume, whether it's on the secondary market or in the primary market through flow. But what we've seen is, you know, more recently, and I would say even since Liberation Day, is these tactical trades, right? So we've been talking to clients about, you know, capturing theta on certain products at different times. So we're seeing more consistent trading volume on products that don't make sense technically, right? So like, you know, if it's April 4th, you're typically buying an April series fund or even a May series fund. We're seeing September series funds, we're seeing October series funds, because the way that the reference asset and the underlying ETF, where they are in their life cycle in the outcome period, there may be an opportunity to capture basically a couple 20, 40 basis points of theta, or just have basically day one parameters. So, right, you can buy a product that's almost as if it's a brand new buffer and cap, but it has a much shorter duration. So I think when we always tell people that you don't want to buy risk management when the market's tanking. You want to have it in place, ahead of that. But it gives opportunity for more tactical trading, more opportunities to capture some of the true components of defined outcome and options-based ETFs.
John, what about KWeb? Again, I come back to how nice it must be to own the whole toolkit, right? The little microcosm of KWeb, KBuff, and 100%. Did you guys see the same things around what seems like a reference asset with perennial volatility?
So in terms of what now?
In terms of using the buffer products
Right.
alongside that core allocation to KWeb.
Yeah. I think that's our initial use cases within our suite were our existing clients that invested in KWeb and wanted to modify their exposure, which is something that we were surprised by, quite frankly, because we were thinking a bit of it as kind of an either or, that, okay, somebody just wants covered calls or somebody just wants buffers. But it turns out that, users are becoming more sophisticated and they're blending things together to customize exposure, because if you know that you can only lose X, so if you buy a 90% buffered strategy and you can only lose 10%, you combine that with either the zero loss strategy, the fully principal protected, or with KWEB itself. But I wanted to kind of mention one thing along this conversation, because there are very few questions I would think on a panel like this where everybody would agree to something. But the one thing that we are, I think, in complete agreement about is that in a lot of these things, whether it's combining defined outcome strategies together within a suite or across suites, or even the role of structured notes with defined outcome strategies, I think that there's a role for all of them in a portfolio. In fact, we'd recently entered into a partnership with Insperex, where Insperex is one of the largest providers of structured notes in the marketplace. And they came to us and said, oh, there are some of these buffered strategies that you have that are really interesting. And some of these capabilities are of interest to a structured notes provider. So what we're finding is that advisor portfolios are becoming really rich as it pertains to the usage of notes, buffers, and really across the board. So we've been asked to do assessments and reviews and analyses that we haven't in the past, just because of the sophistication that we're seeing in portfolio construction.
Really fascinating. And when we think about, again, right, who is buffering what, right? I think it's really safe to say that a lot of folks who are consuming these buffered notes are really, at the end of the day, beholden to that structured note return profile, right? And the array of risks that come with that. I've heard a couple panelists this morning quote the $650 billion opportunity, right, around outcome-based ETFs. In a world where that figure is correct, we're about 10% of the way there. What gets us the remaining 90? I think the partnership with Insperex, is brilliant, right? And maybe the end goal isn't 100% capture of that market share, right? Maybe it's 50%. Any thoughts on what gets us to parity?
I think we've already spoken about like certain elements of essentially how the product landscape matures, right? There will be basically newer structures that will come to market. There will be basically better implementation. There will be basically ways for clients to really, in a very targeted way, kind of express their preferences. We'll most likely capture more markets than kind of what we've done before. And it's really kind of essentially making this a mainstream equity allocation product. Mm-hmm. And particularly at a kind of general macroeconomic time where I would probably see some investors believing that, yeah, we're living in a more uncertain world right now. So the next drawdown might just be around the corner. What do I basically want to deliver either in my own portfolio or to my clients? I would like to make sure that basically everybody can kind of go to bed at night and kind of sleep well, knowing that they do not like miss out on the equity kind of upside if it actually does materialize, while having something in place that actually allows them to protect the portfolio. It's really kind of helping somewhat eliminate that tail event of you kind of really restructuring your portfolio where it's at absolute kind of worst. And I think we're seeing this now. We're basically seeing kind of broader adoption, broader interest, essentially kind of all the product innovation try across various different firms, kind of trying to cater to like various different demands. And this is really kind of just the beginning of acknowledging this as, basically a equity allocation vehicle kind of in the market that can really serve a very, very important purpose going forward.
I like Jonathan's view of defined outcome 1.0, 2.0, 3.0. I think it's spot on the way in which this market's evolved to fit different product needs. And I think it also, you have seen in a way in which this has fit into investor portfolios in the same kind of piecemeal manner. The very beginning of this was a pretty straightforward, understanding of I am buffered against the first 20% of losses and I have a cap of X if I hold this for 1 year. You saw evolutions like the max buffer ETF that we talked about, which, okay, you're protected against 100% of losses. Your cap is lower. It's 7 and 7.5%. Now it's more of a bond-like replacement in my portfolios when you think about that. Then, I've been talking about the evergreen structures, and as Oliver just said, the kind of a core equity holding aspect to it, like that is certainly the next kind of phase. And when you think about growing from 65 to 650 billion, I do think there's going to be product innovations that are very exciting. And one of the great things about this space is that it has proven to be pretty quick to adapt to investor preferences. So I think it will continue to stay at the forefront of ETF innovation. But more importantly, I do think that as this evolves from, kind of one-off opportunity, like I have a client who needs money in a year. This is a great way to get them equity upside, but protect them against losses because there's a near-term liquidity need, to something like this is a persistent allocation for me that I'm then going to allocate around based off of my viewpoints. That opens up a lot of room for growth beyond just there's an avenue of, insurance products and RILAs and structured notes. And it can really, I think, open up a number of different avenues for portfolio construction. And that to me is how we're going to continue to see growth in this space, in addition to, of course, what we will see in terms of cap and buffer structure and new reference assets, et cetera.
Yeah, and I think we're still in the infancy for the most part in the adoption of these products. They're used a lot in the smaller broker dealers. They're used in the RIA community. They're still not approved by and large in the wires and even the national independents, and then institutional. So we've seen some trickle effect into some endowment investments, but from an asset owner standpoint, from an institutional standpoint, we're still not there yet. So we're 7 years into the space for the most part, but I think there's a lot of room to run. So we're about 10% there. I think once we see some of the larger broker dealers approve these products, which I think they will, and we see some more adoption from the institutional side, I think that target is not very unrealistic.
Really great points. And Oliver, I like your qualification there, right? By pointing to a whole realm of capacity, which I don't think the $650 billion figure references, right? And that is really just tail hedging scenarios, right? That is something for which the notional, I think, is well known to everybody here in the room. As much as I'd like to end on that positive note, I'd love to just go down the line, get some thoughts on where new outcomes might bring product innovation. Today, I think everybody on stage is home to any number of buffer strategies, right? Allianz, we see some really innovative implementation of that uncapped concept. GSAM, we see debut commercialization, right, of a fifth leg, really that 25% barrier within the fund strategy. I'd love to hear from all panelists where we see new outcomes headed and how ETFs can complement those structures.
Yeah, so in terms of new outcomes, for us at PGIM, by the end of this year, we'll have upwards of 40 defined outcome ETFs. And it feels like a lot, but I think if we look back 10 years from now, we might have, many multiples of that, because I do think that as the market adapts, you're going to see new innovations, as I mentioned before. For instance, the max buffer ETFs would not have been possible a decade ago. If you go look back at the interest rate environment of the mid 2010s, the max buffer ETF would give you caps of 0, and in some cases actually negative, because interest rates are such a predominant driver of caps in this space. So that doesn't mean that it's an irrelevant product. It's a perfectly relevant product today. And as Eric mentioned, we saw lots of flows into these type of products last year because it made all the sense in the world. But there may be a day where that doesn't make sense. And then we come up with new structures in a way in which that we're giving people opportunities to get outcomes related to different reference assets or different cap structures. It's really tough to say with perfect clarity because the market environment shifts so much. But I do think this idea of a solutions-oriented market that adapts really quickly is something that is, one, unique to the ETF ecosystem, but two, very unique to the defined outcome and buffer ETF ecosystem as well, because of its dynamic nature. So I'm kind of punting on the what's next question, because it's really tough to say with perfect clarity or without a magic 8 ball. But we have seen a lot of innovations here, and because so much of what happens here is market dependent, I think you're going to see continued kind of efficiency and innovations happen. But where that is, I'd be lying if I told you I knew what 3 years from now this is going to look like.
Yeah, going back to my earlier comments, I like to see the evolution of the products, and we're seeing that across all issuers. Right now we're focused on our clients and meeting the needs that they want and desire. Fund of funds was one of those. Another thing that we're coming to market with is shorter outcome periods, similar to Goldman, with the 3-month outcome periods, because clients like that feature of locking in some upside, depending on where the market is over an annualized period. So those have been really popular this year. 100%, as you mentioned, with the time was right with the interest rates where they were. So I think all the issuers are being very adaptive to the markets. We've created products that are more interest rate sensitive, more vol sensitive. So it's really kind of creating a full menu for investors so that they know there's always going to be a right option for them. Whatever their investment sentiment is, they're gonna have an option with the product landscape that we're all providing. And then structurally, how we do it has been great. A lot of issuers started with index options, then they moved to Flex on SPY. Now that we're seeing SPLG as another option. So tuning the structures is really important because it's going to provide the best possible outcome for all of the investors that are using these products.
So I used to run a large investment team at a prominent private bank, and our billionaire clients only wanted three things. They wanted S&P returns, they wanted bond income with guarantees. That's it. Just those three things. Perfect upside, clean income, no downside. And we would say, pick two. And if you think about what the defined outcome space has done, it's allowed you to kind of very explicitly pick some of those parameters, right? Lock in the downside, covered calls, generate meaningful upside, have a cap on the S&P. I can't give you the S&P, but I can give you an S&P with downside protection. So this evolution that I talked about from, first gen, second gen, third gen, I think the next iteration here is taking what is the current kind of best thinking on evergreen type defined outcome strategies and introducing an income overlay. And that's something that we're looking at right now. So again, it's not being able to perfect those three impossible things that are very difficult to get all at once, but to give predictability about how to blend those three things together in one package that's understandable. So that's some of the work that we're doing internally at Crane, and look forward to sharing more as we file.
And I think while many of these objectives are staying constant over time, I think the environment we're in is one of basically constant uncertainty. There's always basically the next thing around the corner where you believe basically or how do I even go about structuring my portfolio to be robust and actually deliver on these outcomes? And I think that will be a key factor in the success also of the evolution of the defined outcome space, is how much can you be adaptive to these macroeconomic changes? How quickly, even in the same product, can you actually deliver something that can really help you maneuver through those various different scenarios? And that will really be kind of a future evolution that we're going to see in that space, and kind of really move, kind of coming back to the theme I touched on earlier, to move from a trade to an allocation. So kind of really have this sustainable allocation in your portfolio that can kind of serve hopefully all three of the objectives that you mentioned, but definitely kind of help cater to your kind of investors' demands.
Fabulous. All great points. I think we're at time, so no questions. We'll let everybody get to lunch. A big round of applause.